Welcome to Geojit Spotlight. After the election results, the market did not see any major correction. Large cap stocks, especially private banks, are performing very well. Geojit Chief Investment Strategist Dr.V.K Vijayakumar joins us to share his views on current market scenario. Welcome, sir.
Thank you, Abhilash.
Sir, after the election-related volatility, the market strongly rebounded and has been setting new record highs. How do you see the near-term, medium-term trends?
Yes, after the election-related volatility, the market bounced back very smartly, and it has been setting newer and newer records. Now Sensex is close to 80,000. A very important trend in the recent rally, a very important characteristic of the recent last 1,000-point rally in the market is that it is being led by large caps. Large caps like Reliance Industries, Bharti Airtel, HDFC Bank, ICICI Bank, Axis, etc. These are high-quality blue chips. And if the rally is led by these fundamentally strong, high-quality blue chips, then the rally will be healthy. That is a very important point. Now, let me highlight a very important characteristic of this bull market which started in March 2020. In March 2020, after the COVID breakout, Nifty crashed to 7,511. After that, after the discovery of vaccines, the market has been steadily climbing up, and now Nifty is about 24,000. A very important feature of this rally, which distinguishes this rally from previous rallies, bull markets, is that this rally didn't experience any major corrections. Normally during a rally there will be 5% correction, 10% correction, even corrections more than that. During the 2003-2008 bull market, which took the Sensex from around 3,200 to 20,000 by end 2007, there were many corrections of more than 5%, and there were several corrections of more than 10%. But in this rally during the last 4 years, only on one day the market corrected by more than 5%. That was on June 4th when the election results came. But the very next day the market bounced back. So this rally is completely devoid of any corrections. The question is, why this peculiar market construct? The reason is this rally has been characterized by the success of buy on dips strategy. Whenever the markets corrected, investors have been buying, and that has proved successful. When the market sets new record highs, it always happens. And one reason for that is more than the FIIs, DIIs and domestic investors, both institutional, retail as well as HNIs are calling the shots now. If you take the last 30 months, 2 years and 6 months, FIIs have invested only around 52,000 crores in the Indian market, whereas DII investment plus retail investment plus institutional NPS, insurance, all this put together is more than 6 lakh crores, more than 10 times the money invested by FIIs. So when you have such huge spontaneous inflows of money, this money has to be invested, and that is why you have sustained demand for stocks, and market has been remaining resilient. But then this year the Nifty has already given 10.4% returns in the first 6 months, on top of the 20% returns delivered by the Nifty in 2023. These are very good returns. Therefore, since valuations are high, investors should be realistic and expect only modest return, moderate, I would say, moderate returns going forward.
You have been warning about the excessive valuations in the mid and small caps, but they are strong and resilient. What are the risks now?
many voices in the industry, sane voices in the industry, including mutual fund managers, highly respected mutual fund managers with more than 2 decades, 3 decades of experience in the market, have been warning about high valuations. The regulator SEBI has been constantly warning about the excessive valuations in the mid and small caps. In some segments of mid and small caps, valuations are about 25, 30, and in some growth segments 40, 50, 60, 70, 90 P in some segments. When there is a news that the company has got good orders, there is buying, and the valuations reach sky high levels. The reason why I am a little bit concerned about this is I have seen a lot of value destruction when the bull market ends and there is a market crash. For instance, there was a big crash in 2008 after the 6-year bull run before that. There was a big crash and the small cap index crashed by 78% in the 2008 crash, 78%. And the small cap index reached the same 2008 level only in 2016. Investors had to wait for 8 years to reach the same level as they were in the small cap index in 2008. This is huge value destruction. Now, when there is a very simple mathematics which everyone should understand is, when a stock or an index declines by 2/3, 66%, then it will have to triple to reach where it was before the crash, right? This is very, very important. And also, again, newcomers who came to the market during the last 4 years, after this post-COVID rally began, they are not aware of the hundreds of companies that have vanished from the market, right? Business Standard newspaper did a very interesting research paper. They published that a few years ago. That story was on vanishing stocks. So their research showed that 700 companies had vanished. 700 stocks had vanished because the companies had gone bankrupt. These are companies which made their IPOs, raised money from the public, and again after the listing, many people bought the stocks, and all these 700 companies have vanished, destroying the wealth. People have lost 100% of what they invested. This has happened before also. Hundreds of companies have vanished. So when a crash comes, I'm not saying that all mid and small caps are risky. No, there are high quality small caps, high quality mid caps, no doubt about that. And for that, you can invest through the systematic investment plans of small cap mutual funds. You will not lose 100% of your investment as you will be losing when you invest in individual stocks. So this is the high valuation, bubble valuations in this broader market, which I am concerned about. And this is the message that we have been telling. So I repeat this point, valuation comfort is in large caps.
Sir, last year your sectoral pick was capital goods. This year, early 2024, your sectoral choice was automobiles. Autos also have done well. Any mid-year review of sectoral choices?
Yes, last year our pick capital goods did exceedingly well, better than my expectations, to be frank. In 2024 beginning in January, in the video that we did, my sectoral pick was automobiles because the industry was in a cyclical uptrend, and it has delivered. The first 6 months up to 30th June, Nifty delivered a 10.4% return, but Nifty auto index has delivered 36% return. That is huge outperformance. But then it makes sense to remain invested because the industry has a good future for the next several years. Therefore, remain invested. Partial profit booking may be done for those who want to do profit booking. Otherwise, remain invested because some of these stocks have great potential. Now, if you ask me about a midterm review, Well, I'm not making a midterm review, but then there are some segments which are showing, some industries which are showing better prospects for the near term. For example, financials have already done well. They will continue to do well because the Q1 results, which will be getting published from next week onwards, financial results will be good. FMCG will do well going forward for the medium to long run also, because monsoons are good, above long-term average. Therefore, rural recovery will boost FMCG consumption. Then IT stocks are now seeing contra buying because they are high quality stocks. Therefore, they are witnessing a long-term buying. So that is a medium-term review if you want a medium-term review. But let me highlight some major trends which are happening in Indian economy, Indian markets, Indian consumption. Very briefly, there are three trends. There are many trends, three important trends. These three trends are: number one, financialization of savings; number two, premiumization of consumption; number three, digitalization of business. Let me explain. Now, financialization of savings means formerly people were savers and not investors. They were depositing money in banks. The modern younger generation are tech savvy, they know more. Therefore, they are directly investing in the market. They are not savers, they are investors. So this has created what can be called a financialization of savings. Savings are directly going into stocks, into mutual funds and other asset classes. This has created a new sector, many segments in the new financial services sector. For example, formerly financial services meant banks and non-banking finance companies, right? Today, financial services segment has many sub-segments. For instance, stock exchange is one segment. Bombay Stock Exchange is a stock which you can buy in the market. CDSL is a depository stock which you can buy from the market. HDFC AMC, Nippon AMC, UTI AMC are asset management companies in mutual funds which you can buy from the market. Then there are wealth management companies. So this financialization of savings has thrown up a whole host of new segments in the financial services industry. And this segments will continue to do well for many years to come. The growth will be phenomenal. The valuations are very high, that's a different story. But I'm just highlighting this trend that is happening in the economy and markets. Second segment is, second trend is premiumization of consumption. Right? FMCG is struggling, but premium consumption, star hotels are doing very well. Premium vehicles, sports utility vehicles and premium vehicles in any category are doing well. Jewelry business is doing well. So this premium consumption in premium products, always the margin will be high and therefore they are doing well. So there are opportunities there. And third is digitization of business. New platform companies like Zomato, Policy Bazaar, Paytm, Car Trade, a large number of new segments like that. These are segments for which the growth potential for many years is very, very bright, but investors have to be cautious about the valuations when they buy, and also the management quality. The management quality is doubtful, then there can be big risk in the market.
So what are the major risks going forward?
Markets always have been impacted by presently unknown risks. Right? Known risks can be easily factored in by the market. If you take the last two risks which impacted the market, one was the COVID-19 pandemic shock. The second was the Russian conquest of aggression in Ukraine, which led to this war in Europe. These two were totally unexpected. Nobody thought it will happen. It happened, it impacted the market. Therefore, there can be a presently unforeseen geopolitical risk which can impact the market. So the big risk is the high valuations. When the valuations are high, this geopolitical risk can impact the market. But there is one known risk now, which is not being discussed in the public domain very extensively. Some leading economists are talking about that. Others are not yet talking about that. This risk which I want to convey is the possibility of a trade war between China and the US. This is a likely event if Donald Trump becomes the US president in the November elections. That possibility is high now, particularly after the Biden-Trump debate. Therefore, the reason why I am telling you this, I will do the economic analysis of that. China is in a slowdown. Their growth rate is now down to 4%. The real estate market in China, which accounts for 24% of their GDP, has been in crisis for some time. So demand also, since growth is only 4%, domestic demand is sluggish. And therefore, they want to compensate this sluggish domestic demand with aggressive growth in exports. Therefore, they are trying to push exports aggressively through aggressive pricing, through dumping, aggressive pricing, and that is being resisted. Few weeks back, the European Union substantially increased the import duty on Chinese electric vehicle imports, ranging from 12% to 38%. 38% import duty means your imports will not be viable at all. So that is happening already in a small way. The European Union is not aggressive like the US. If US under Donald Trump as president sees this threat, certainly they will react in a strong manner. Trump has already gone on record that he will impose 100% duty on Chinese imports. So China will retaliate to that. So a trade war is a possibility towards the end of this year, particularly under a Trump presidency. A trade war can impact international trade. This year we assume that the international trade will pick up from the poor growth of the last 1 year, 2 years. So the international trade will be impacted, global growth will be impacted, global growth will impact all the economies, and the stock market also will be impacted. This is one risk factor when we look at the economy and markets from the perspective of today. What will happen tomorrow, we cannot see.
Thank you, sir. Thank you very much.
Thank you.